Welcome everyone to this Friday webinar. We have Mr. Vikas Gupta, who is the CEO and CIO at Omniscience Capital, today presenting a scientific framework. He is the inventor of this very interesting scientific framework that we'll be discussing today. We have been seeing, markets making all-time high, and 2023 has been a cheerful year. 2024 has also, started on a very good note. So, we have been trying to deep dive through some of the innovative and unique strategies. What is the perspective of markets and, way forward for all of us? This particular, entire webinar is more of academic nature to understand the scientific framework. And Asit Mehta, which is the name of the PMS that is running under the, I would say, realms of under the thought leadership of Omniscience Capital, is the one that ultimately is a product that we'll be discussing eventually. But let's first hear out Mr. Vikas Gupta on his entire thesis and what is behind the entire scientific framework for managing this Asit Mehta PMS. Welcome, Vikas, to this webinar. We at PMS AIF World have been doing webinars every Friday, and I have interviewed almost each and every portfolio manager, and it's a very interesting journey over last more than 5 years. And I know I have conversed with you in the past, but this is the first formal conversation that we'll be having over this webinar. So I am keenly looking forward to hear from you on this webinar. I hope your presentation is uploaded.
Absolutely, it's loaded. Yeah.
Perfect. So wishing you all the best. We'll be spending first half an hour to understand your presentation, and then we'll do Q&A in the end.
Perfect. Thanks, Kamal, and a pleasure to be here at PMS AIF World. And it's always a pleasure to talk to your esteemed audience, who's extremely sharp and who understand the markets. So it'll be fun to have this interaction. So I'll present a little bit about the scientific investing framework, the philosophy. So basically, because to people, PMS is a PMS, and they've heard so many PMSs and they've seen. So the whole purpose of this is to introduce the scientific investing framework and kind of convey the difference it has from the other philosophies. So that is the aim, and that is what I'll try to do. But the Q&A is the part when people can actually clarify a lot of things. So I would like to have a lot of time for the Q&A. So I'll try to finish faster. I might move fast on some slides, which is, I think, not a problem, because those things you can refer to later on also from the presentation. So may I start, Kamal?
Absolutely. Please go ahead.
Perfect. So the broad theme of this PMS is about the long-term investment opportunity in India is what we call the Bharat Amrit Kal opportunity. Okay, so that is what the title you will see. And within the Amrit Kal, I mean, you can interpret Amrit Kal in numerous ways, right? So within Amrit Kal, what are those hidden investment themes? So some of those will also come out as part of the explanation or a live example of the philosophy of scientific investing framework. Okay. So this is about ACMIL. So very long history, nearly 40 years, started by Mrs. Deena Mehta and Asit Mehta. So we'll not get into too much detail. The idea is to spend time on the philosophy. So these are the promoters, Asit Mehta, Deena Mehta founders. Now, additionally, Madhu Lunawat and Mahavir Lunawat are also part of the group, leading the group. For your information, Deena Mehta was the first lady president of BSE. So it's a very illustrious backing. Number of achievements for the PMS. So I'll just read them out. They got the 5-star rating from CRISIL. and was top 10 performer for last 1 year at the end of November. Numerous awards continues. I mean, I can't even count or see what is that. Will require an AI to do it, I presume. So let's come to this. So Amrit Kal is the period from 2022 to 2047, the 75th year of independence to the 100th year of independence. Our simulations show that we could be somewhere in the range of a $50 trillion economy. Now, people are not even convinced about 5 trillion, and we are saying 50 trillion here. And so we'll explain all of that. It's on a very logical and sound basis. That is something you need to focus on and understand that opportunity. These are the assumptions behind the simulation. So it's no heroic assumptions here you can see. It's a 8%. Okay, one thing I want to clarify is when GDP discussions happen, people get confused a lot. When few years back, people were saying 5 trillion, it won't happen, and so on and so forth. Today, we are sitting at nearly 4 trillion, practically. Okay. So but there was a lot of confusion 4 or 5 years back that how we can be 5 trillion. Okay. The confusion is arising because of 2-3 things. Number one, people confuse there is normally when we discuss GDP growth rate, that is the real GDP growth rate, which is somewhere around 6%, 7%, 8%, or 9% sometimes for a year or so. But we have been last 20 years, at least we have been doing more than 7% consistently. Of course, there is a COVID year, there is a global financial crisis year, there is a taper tantrum year of 2012, etc. When things might be a slow, and economy is a cycle, so it will go up and down. But on an average, the 20-year average is 7 to 8%, and there have been consistently 5+ years or 4+ years when we have done 8% plus real GDP growth rate. Now, the nominal GDP is real plus inflation, okay? And then you get the nominal GDP. So when normally we say that, okay, GDP was so many lakh crores last year and it's now so many lakh crores, that is typically the nominal GDP, what is used in the budget or things like that. So nominal GDP will be higher than real GDP. Real GDP of, let's say, 7.5 is the average for last 20 years. So that's a base case easily. On top of it, around 5% inflation. So that's 12.5% nominal growth rate. Now, we are talking in dollar terms. So we have to incorporate a depreciation of the rupee as well. So roughly around 2% depreciation. So that brings us to the base case of 7.5 real GDP plus 5% nominal GDP. So that is 12.5 nominal GDP minus 2%. So 10.5 dollar GDP growth rate that we have been doing for last 20 years. And those were not the best years. I mean, our infra is still improving. So imagine 20 years back, infra was how low quality it was, how poor it was. So it's been improving, and during a poor infra, poor policy period, if we grew at 10.5% dollar GDP growth rate, you can imagine what we can do going forward when things are improving and continuous reforms are going to happen. So these are the simulations. So we have actually, our very conservative estimate is actually at 8%, the lowest one if you see. 8% dollar GDP when the base is already 10.5, okay, in the past. So 8%, 9%, 10%, 12%, and 14%. The very aggressive is 14%. Now, how are you doing 14% is the natural question, or even 12%. So you have to understand that sometime later we are going to be producing so much that we will have exports in very large quantity. We will become a net exporter. Once you become a net exporter, your currency actually starts to appreciate instead of depreciating. Okay. And you have a lot of FDI coming in because of this opportunity itself. So it is a virtuous cycle. Okay. If you are producing more, you can sell more outside the country. If you're selling more, your currency is appreciating and your GDP is growing. If all of these good things are happening, more FDI and FI is coming in, which makes the rupee appreciate even more, and so on. And you have more investments, etc. Right? So given all this, that is the 14% growth rate, which is 8% GDP growth plus 4% inflation plus 2% appreciation and so on. Okay, so when that happens, our worst case scenario is something like a $24 trillion economy 25 years from now. Next level is 36 trillion. Above that is 38 trillion, and then 60 trillion nearly, and then 90 plus trillion. 90 trillion, you are number one economy in the world. Either way, today we are fifth largest economy. 2 years from now, we are most likely going to be the fourth largest, beating Germany. And maybe 4 years from now, or 5 years maximum, actually it will be more closer to 4 years, will be beating Japan and become the number three economy in the world. If the optimistic case and aggressive case comes true, we will be either number one or number two economy in the world. Okay, so it's a very big thing and a very big opportunity. And it's not that you have to invest today and wait for 25 years. I mean, this is throughout values getting created in the economy. And naturally, what is created in the economy is reflected in the markets. So this is what the opportunity is. Now, the objection people have is fine. I mean, you are number 5 today, but you're still poorer than number 6, which is UK. And the people are poor, right? So just because of a very large population, you are larger. True. So let's look at GDP per capita simulation. And here is the GDP per capita. In the worst case itself, we are talking of nearly $15,000 per capita. Next is nearly 18 to 19,000, then 23,000, 36,000, and last is 57,000, 57,000. For reference, we have shown in the table below what is the different per capita incomes. China today is 12,000, Poland is 22, Japan is 34, Germany is 52. So other than China and India, everyone is developed. As soon as you cross $14,000 or $15,000, you are in the developed economy. Each person has a lifestyle of a developed economy. Okay, so you can see that practically even in the worst case scenario, you are at a developed economy or what is called Viksit Bharat. Okay, so the end goal of Amrit Kal is that if the optimistic cases happen, we could reach there much earlier, probably somewhere between 2035 and 2040 itself will become very close to a developed nation in terms of per capita as well. Different focus of investments, AI, India, yes, US also remains an opportunity. So this is the most, now we are getting into the philosophy. So that's an opportunity. Amrit Kal is an opportunity. How are you going to get that? Okay. There are various ways to do that, but when we are in the markets, we have to start from the risk. We have to understand all those things. And most market participants chase alpha or chase high returns, but what they get is risks, right? You have heard high risk, high returns. So the first line is actually that if you try to chase high returns, you'll end up with risks. But you could, this is the main insight, that you could chase safety and get alpha. Okay. So we'll come to that, how that is done. So high risk, high return is true on asset class level. So if you put money in SBI bank fixed deposits, of course that's safe. That's low risk and low return. But if you come to equities, which is high risk compared to a FD, right? But it also is high returns. That's true at the asset level. As soon as you get into an asset, like let's say equity markets, now high risk, high return is no longer true. That is our belief. That is our base of our philosophy. Rather, low risk is high return. If you chase safety within the markets, then you will end up with alpha. And I'll show you how. How it has evolved, we will not get into that. That will take too much time. But it took decades for this to evolve. It's based on more than 100 plus years of investment research. And the core ideas come from all the greats like Benjamin Graham, who's guru of Warren Buffett. Warren Buffett, of course, you all know, and that's the correct pronunciation, Buffett. It's not buffet. He's not lunch to have, He's Warren Buffett. double T. His guru, another guru is Phil Fisher. So Graham is more focused on valuations. Fisher is more focused on the growth, what drives growth and what makes a high quality company successfully grow. Okay. Then John Burr Williams is the actual DCF. You know, you've heard of the discounted cash flow. The actual concept, all actual mathematics was developed by John Burr Williams. Then we come to these two guys, Charlie Munger and Warren Buffett. You know, they are partners. So Charlie Munger just died few months back at 99, but he was the vice chairman of Berkshire Hathaway. Now the thing and I put Peter Lynch here. Peter Lynch was the most successful fund manager in 1979 to 1992 in US. Okay. With the largest fund, he was the most successful fund manager, generating 29.2% CAGR over the 13-year period, beating Warren Buffett. The reason I'm talking about these two guys, Munger and this, lot of people, you have been investing in other PMSs or you are familiar with those philosophies of most of the fund managers, successful managers in India as well as globally. And lot of them have learned something wrong, in our opinion, from Charlie Munger, that you need to have a concentrated portfolio. And the concentrated portfolio can be as small as a 3-stock portfolio. Okay, so Charlie Munger says, I just have 3 stocks. Says, and people get confused. I mean, he's the sharpest guy, I mean, there. But when someone is saying something, there might be some context. You don't know the context. It is. So I'll just contrast first. So he talks about a 3-stock portfolio. On the other hand, Peter Lynch, who beat Warren Buffett during the 80s and generating 29.2% in dollar terms, CAGR basis, he had 1,400 stocks in his portfolio. You will say, I mean, so many stocks even listed on the market. But yes, he had 1,400 stocks. And most of the time, 200 stocks had significant allocation. So 200, it's not 20 stocks. It's not 3 stocks. Okay. So what is going on here? I will not get into it. I'll just say that one of the stocks Charlie Munger has is Berkshire Hathaway. So just for namesake, he might have 3 stocks, but within Berkshire Hathaway, which is practically a fund, there are more than 120 stocks. 40 to 50 listed companies, including Apple, are there in Berkshire, and 70 odd companies are there which are unlisted, private, fully owned companies in Berkshire. So it is wrong when he's saying that I have only 3 stocks. Okay. So just keep that in mind, that and the Peter Lynch part, that you can generate the largest amount of returns with the largest portfolio in US over a very long period of time, despite having 200 to 1,400 stocks. So diversification works. Okay. So this is the scientific investing framework now. First principle is to enhance safety. Now, when we say enhance safety, it is on a fundamental level. So there are nearly 2,000 stocks in the market. Now we use a cutoff called the 1,000 crore cutoff. So it could be 1,000 crore market cap. Today there are around 1,200 odd stocks above 1,000 crores. But even when market is down and in a bear market, even then there are roughly 1,000 stocks above 1,000 crores. So those 1,000 is the starting universe. Smaller companies than that, the information transparency is very low. So you don't know what is going on. And lot of very good investors have burned their fingers trying to do this, even when they were sitting on the board, okay, as private equity or whatever, or they were very closely working with the promoters. They didn't know what was happening. There are numerous examples. I will not specify those because it will look like finger pointing to our peers, you know, some of our esteemed peers. They've burned their fingers. Most of you know those stories. So above 1,000 crores, how do you select? So 1,000, 1,200 companies are there in the full market, starting universe. First thing is to take out capital destroyers. So capital destroyers are companies which have the highest fundamental risk. We want to have a safe portfolio. We don't want those risks. So capital destroyers are weak balance sheets, which means there's a lot of money on the balance sheet which is coming from lenders and not from equity shareholders. When that happens and there is smaller amount from the equity shareholders and something goes wrong, it could be the COVID shutdown, right? So if something goes wrong, you're not able to pay the interest, the company comes under the ownership of the lenders, people who have given the debt, right? And the shareholders are wiped out. So the shareholders' capital inside the company net worth is wiped out to zero. So that's why we call it capital destroyers. This includes highly leveraged balance sheets. It includes consistently loss-making companies. Not in any given year. COVID year, of course, many people went through losses. That's fine. Or during an economic cycle, the down cycle, somebody has a year or so of losses. That's fine. We're talking of consistently loss-making companies, companies which hardly make a profit ever. Why do they exist? I don't know. But they are there. They are in the listed space, and many people buy them. Okay. So we take those companies out. So the portfolio is already now safer. And if you do the calculations, you will actually see that this. So let's say I have 1,000 companies or 1,200 companies, which are about 1,000 crore market cap in the full market. And the return is roughly the Nifty 500 returns, right? Or Nifty 50 returns, nearly same. 1 or 2% difference, maybe sometimes between 50 and 500. So that return. Now, when I take out the capital destroyers, there would be somewhere between around 0.5% to 2% kind of extra return. So the portfolio is safer. It has 600, 650 odd companies which do not have capital destroyers in there, or very low probability of finding a capital destroyer in there. And the total return goes up because that capital destruction is not happening, which is happening in the full market portfolio, right? So capital destroyers gone, lower risk portfolio, slightly higher return portfolio. Next is capital eroders. So these are companies that still have risk, fundamental risk. They are showing a profit. Their balance sheet is also relatively better. So they need not have a very high amount of debt, but their profitability is low. So they are generating a profit, they are paying taxes, but given the kind of investments, the shareholder net worth in the company, that net worth is not generating enough returns. It is generating returns like an FD, in which case shareholders would have been better, instead of buying the plant, property, machinery, it would have been better if the company just deposited the money in a bank fixed deposit. So the longer you stay with such companies, they're compounding your capital within the company. The net worth, the book value of the company is being compounded at a slower rate. So, and slower than the cost of capital. When that happens, it's eroding your capital, even though it looks like book value is actually growing. Even though it looks like, earnings are actually growing, revenues are growing, it is eroding your capital. So you take those companies out as well. So let's say now 200 more companies are gone. So roughly 300-400 companies are left, or maybe 200 companies, 250, 300 companies are left. Now we come to a very important concept. Here is where you have to pay attention and ask me questions if you don't understand. Is the difference between us and most of the fund managers. Now we are left in the portfolio with only high quality companies, right? Fair to high quality companies. But the lot of those companies are well known to Mr. Market. Everyone in the market knows those companies, and then they are priced higher and higher until they become overvalued, and they become more overvalued, and they become extremely overvalued. When that happens, they are priced to perfection, we call them. Price to perfection is, companies which are priced at, let's say, 25% growth rate for 25 years. So you project, someone does an Excel sheet calculation of DCF with the cash flows growing at 25% compounded for 25 years, then does a discount rate of somewhere of 10 to 12% is the discount rate. And then does a present value, and then says, oh, this company is still undervalued, I'll buy it. Okay. Now think about this model. You don't have to understand what is DCF. You just have to understand that when you are saying this is fairly valued, this company needs to do 25% growth rate for 25 years. And then if all of that happens, you just get 10 to 12% return, which is the discount rate. Okay. Now, what is more likely to happen in today's disruptive world, when so many innovators are there, so many entrepreneurs are there who are innovating and trying to beat, established companies, disrupt them using technology, using New things are happening all the time. So the chances of disruption and foreign competitors could enter, right? Then what happens is next 5 to 7 years, the likelihood is very high that the management comes back to you and says, look, we can't do 25% growth rate. We'll be able to do 21% growth rate. And as soon as they say that, the share price is going to implode because what it is priced to perfection. And with a 21% compounding for next 20 years or 17 years instead of 25 for 25 years, your value goes down by somewhere between 40 to 60%. And so that kind of a crash you will see in next few days or weeks. So that is why we call these price to perfection or extremely overvalued stocks, in our opinion, as capital imploders. We take them out. So now what you're remaining with is what is called capital multipliers, clean balance sheet, strong, persistent competitive advantages, high returns on capital, and priced fairly or significantly undervalued. Okay. So your safety is high and your returns are higher. 3 levels of excess returns now. Because you took out the destroyers, then you took out eroders, now you took out the imploders. Things are not finished. Next, we move to enhancing growth. Okay, so here, now you're, let's say, left with somewhere around 70 to 120 companies. Company by company, our team analyzes and tries to see which companies have growth opportunities. And those growth opportunities have to be multi-decadal, very long-term growth opportunities. When such opportunities are there, these are called growth factors. Growth factors are driven by, catalyzed by what we call drivers, growth drivers. Okay. Growth drivers could be technology, like artificial intelligence could be a growth driver, or digital transformation could be a growth driver, or it could be political. Certain policies are being made, that could be a growth driver. Certain regulations, when you become very hard on certain environmental hazards, right? So China became very hard on environmental management, and all the chemical companies had to shut down for a period of time. Indian companies got an opportunity. Okay. US did that long time back, and all of the chemical companies had shifted to China that time, right? So these things can last for a very long time. It could be regulatory, it could be social, like the trend for fitness or wellness, right? So you are moving away from sugary drinks. So at one point, Buffett had said that if the market was closed for 10 years, what stock will you buy? And he said Coca-Cola. Today, that doesn't make sense because people do not want to consume sugary drinks to that extent. They want healthy drinks, right? So fitness or wellness is a long-term socially driven growth driver, and so on. So it could be because of various things. We try to find out company by company which companies have high historical growth rates, what is driving them, is there a growth driver, is there a growth vector they're exposed to. On top of it, does the management know they are exposed to this growth vector and that's why they're growing? Sometimes management doesn't know that. Even if they know, do they have a very concrete and convincing strategy, convincing to us that they can use that strategy and be a winner in that growth opportunity? So all those analysis goes on. And finally, we create a portfolio of somewhere between 25 to 50 stocks. Typically 25 stocks, but last year market was down. We got many more opportunities. So it's around 35, 36 stocks right now. But typically 25 to 30 stocks. We rarely go below 25. I think we've never gone below 25, in fact. But even if I had to compromise, I would never go below 20 for a diversified core portfolio. For certain thematic portfolios, we are okay to go smaller when we know your allocation is not the core allocation. Right? But any core allocation, 25 stocks. So that is highly diversified, 4% each. Right? We don't have a skewed portfolio. We have equal weighted portfolio. Secondly, there are number of growth vectors, different growth vectors. So stock diversification, sector diversification. We do growth vector diversification. So number of different growth vectors are there in the portfolio. Many of them are less correlated with each other, sometimes zero correlation with each other or negative correlation. So what happens is, suppose I have 6 growth vectors. And within each growth vector, let's say I have 4 or 5 or 6 stocks, right? So that's around 30 stocks. Now, each growth vector is not recognized by Mr. Market today. That is why it is undervalued and that is why it's in the portfolio. The full value of it is not recognized. As we hold it, we obviously hope that some point of time Mr. Market will realize the value and want to buy at a higher value. When they want to buy at a value higher than the intrinsic value, we want to sell. So let's say they are uncorrelated 6 growth vectors. So we have 3-year holding period, let's say. So every 6 months, the likelihood is that one of the growth vectors is going to unlock. Okay. And so that makes the portfolio more consistently generating returns compared to a portfolio which did not have the growth vector diversification. And it makes it less volatile and it creates the probability of higher return generation in each period, each 6-month period. Okay. So this is broadly what the philosophy is. I'll not get into too much details about growth factor. These are enough ideas to digest for today, and then we'll ask questions and clarify. Each investment has some of these patterns, market anomalies we call them. I mean, you will wonder why would market not price something correctly? Okay. So yes, that's a good question, natural question, but it's a base. Everyone has the same information. Sometimes people don't collect all the information or they don't pay attention to all the information. Sometimes you have all the information, you're paying attention, you've incorporated it, but you've not analyzed it correctly. So analytical inefficiency or error, you can say. Okay. And it's very common. It's behavioral economics has covered this, that why people, very, very smart people analyze things wrongly. Okay. Me and you, everyone would do that. So that's why that opportunity is available. And when we do it right, we get those opportunities. Now, the specific growth factors right now in the portfolio, and these have been there typically for last 3, 4, 5 years now, but they're all unlocking one by one. So the bullet train, okay, is just the name of the growth factor. It's basically railway infrastructure, which includes the bullet train projects. There are around 8 projects in different stages of work, right? Most of them in planning stage, but one is in completion stage now. More than 12,000 railway stations to be redeveloped, more than 30 metro projects going on across the country, nearly 400 Vande Bharat trains to be launched in next couple of years, and the eastern dedicated freight corridor and the western dedicated freight corridor, with which the government is targeting, or the railway rather is targeting, to capture 45% of the cargo shipping across the country. So today, railways has only 27%. It is trying to target 45%. And mostly it will be from the roads. Roads are very inefficient, very high cost. Trains are much, much more cheaper. So this is part of the PM Gati Shakti project, okay, where the aim of the project is to bring the logistics cost from 14% of the GDP to 7% of the GDP. Okay. These are very important, very large capital involvement projects which will last for decades. And yesterday also you would have heard in the budget, the 3 new corridors that have been discussed. So the first corridor is the energy, minerals and cement corridor, right? So what is that? Basically resources corridor. Resources as in the raw material which goes into production of manufacturing of something. So bringing the inputs to the factory, that's one corridor. Now you put it together, you'll get the philosophy of what is being planned. Next is the port to railway connectivity corridor. Now what is the Britishers built ports to bring raw materials from India to UK, England, and sell us back the finished goods from England back to India. Okay, that is what they use the ports and railways for. Now we are doing the complete opposite. We will bring raw materials from within various places in India or sometimes outside to the factory, produce in the factory and take it to the ports and export. Now connect with another piece which was mentioned in yesterday's budget. India, Middle East, Europe corridor. Okay, so that whole purpose of that is to counter China's One Belt, One Road project and to replace China as the production hub in India. So India will produce, it will go to Middle East, it will be consumed in Middle East and Africa, and it will be consumed in Europe. Okay, so that is the philosophy. The target is $2 trillion exports by 2030, and of course, beyond that, it will be more. So this is a huge project. At the heart of it, at the core of it, is the bullet train. I mean, we call it bullet train, but it's the railway infrastructure growth vector. So you can start seeing what kind of growth vectors we identify with this philosophy of scientific investing. Okay, strong capital expenditure, it's crazy, more than 15 times in 13 years. I'll not get into the details of this. Same way, there is another opportunity which is more accessible globally, specifically in US markets more, which we call AI revolution. As part of AI revolution, artificial intelligence revolution, there is digital transformation, which is the first stage. And before that is the cloud. So you move data to the cloud, then you do digital transformation, then you do analytics, and then you come to artificial intelligence. Once you use AI, it is like agriculture revolution was the first revolution in the world in terms of growth. Second was industrial revolution, and this is third one, AI revolution. It's of that scale and impact. Okay, so that's going to last for decades. Third is defense. India's defense. We are number 3 defense country in the world by expenditure. Now we become 4th because Germany decided last year to spend 2% of their GDP on defense. Okay, because they are not comfortable with NATO supporting them. So because of that, they started doing it, and now we are 4th for some time. We might again be 3rd pretty soon. But right now we are 4th. Our defense spending is much below what it needs to be. So the opportunity is again going to last for decades. But the most interesting thing is we have companies, hardly any companies in the world who can make aircraft carrier. We have some of those companies, and they are listed. They were part of the portfolio. Second, how many companies in the world can make stealth submarines or nuclear submarines? We have those companies, they are listed, they were in the portfolio, right? How many companies can make missiles, guided missiles, torpedoes, etc.? We have those companies, right? How many can make those radar control and do space control using electronics? We have those companies, right? So all these kind of companies are there. There are 2 defense corridors being planned, one defense production corridor in UP, one defense production corridor in Tamil Nadu. Right. So there is huge investment going on continuously. What has to be procured only from Indian companies is being defined by the government. And wherever you are doing imports, they're creating tie-ups. So huge opportunity here. It's just started. I would say it's just started. Power, when you grow at these kind of paces, as we have shown, the requirement for power is very, very large. And within power, renewable and clean energy is even more important. Okay. And when we say a growth vector, it can be everything: generating, transmission, financing of those capital investments. It could be the energy exchanges. Okay. It could be the grids. All kinds of opportunities are there. Capital enablers. When you are going to grow at such a large pace, when you need so much investments, then who's going to win? Somebody who's lending, somebody who's giving capital. So lenders, which includes banks, which includes NBFCs, right? Who's going to win? Stock exchanges, rating agencies, and so on. Okay. So all kinds of, and then whole fintech and payments. I mean, UPI is the world's #1 payment technology. Okay. The size of it and the efficiency when it can transfer even 1 rupee in seconds from one account to the other, that's unheard of. All the developed countries envy India, and they look at UPI. So that's just one of the projects. Okay. So Bank on Bharat, we just discussed capital enablers, but this is even more focused on purely on banks. Because our banks today are at a cyclical low, this is the time. Going forward, their return on equity is going to expand, so the earnings will accelerate faster than the revenue. Balance sheets are clean. Digital banking is being adopted by everyone, public sector, private sector, everyone is becoming very good at digital banking. And in fact, they're beating the innovative fintech companies here. Okay. And then this huge opportunity. People chase some specific stock with electric vehicle, oh, I want EV company, and you just chase some specific company. Here, this is the whole future of mobility. That includes everything. That includes public transport, that includes railways, that includes waterways, that includes electric vehicles, that includes green hydrogen. So this is a broad-based growth vector and so many opportunities. You have to think carefully. It's not just the guy who's producing or the company which is producing the electric vehicle, four-wheeler or something. No, there's much more to it. There are the battery manufacturers. There are the rare earth metal companies which are going to supply to the battery manufacturer, right? You can make money anywhere. You can make money in the charging infrastructure. That again, by the way, was mentioned by the finance minister in the budget yesterday, right? Then when you produce all this electricity, it has to be stored somewhere, okay? And what technology you are using to create it in the first place, to produce it? Renewable, non-renewable, and so on. So we come to the product offering. There is the ACE multi-cap, which is basically a flexi cap, So large, mid, small, it can have anything. It's not decided that what percentage will be in mid cap, large cap, or small cap. But typically, yes, 15, 20, 25% or even more, 40% stocks are large cap, sometimes even 50% plus. Today, I think it's more than 50% plus in large caps, but it can have anything. So it will keep changing over a period of time as we rebalance, right? ACE 15, which is the pure large cap, 15 to 20 stocks from the top 100 stocks. Okay. Now, typically 20 stocks. We don't like a more concentrated portfolio, but sometimes, we might go to 15 also. ACE mid cap is the 20, 25 stocks from the mid caps, next 150 stocks. And ACE regular income is something which does a payout every month of 0.5% to the investor. If the portfolio is down, it could be from the capital for some brief period. But in general, it is generating returns over the long term. So it is mostly from the profits, you can say. But over, let's say, 3 to 5 years, it stabilizes, and then the capital also is appreciating and the payout is also appreciating. Approximately 6% per annum is the payout. That's paid every month. Okay. So I've already explained the concepts here. I don't think we need to go into that. Performance, again, I am not someone who wants to talk about performance. Performance is seen. You are on PMS AIF World, you will be able to see what is the performance of Asit Mehta various strategies. So I am not going to go into that. What I will point out is the P ratio of the portfolio. So despite the kind of returns it has generated, okay, especially last 1 year, but you see over a consistent period of time, it has been beating the benchmark, and not some couple of percent. It has been beating by much more. So the alpha generated is huge. But despite that, the portfolio PE, this is end of December data, 16, compared to benchmark of 24. But I would say now it would be roughly around 18 PE. Okay, so it's much cheaper portfolio compared to the market and a higher growth portfolio. Okay, so that is something. And of course, it has generated higher returns. Another thing you will see, beta is lower than the market. So from that definition, also it is lower risk. Standard deviation is slightly higher, but the Sharpe ratio is much higher. Okay. Yeah, I'll not get into that. That all you can see on PMS AIF World yourself. So this is the regular payout. That again you will see has been beating the markets, and the portfolio P ratio, etc., is fairly low. This is the large cap. Again, beating the markets, beating the benchmark. P ratio is again around 16. Mid cap, again beating the benchmarks, and significantly. I don't want to elaborate more than that. You can go and see on AIF World. Nearly 18.5 P. I would say by now it would be around 20. Okay. approximately. Fees and charges, again, I don't think we need to spend time. It's just standard stuff. This is the team which is behind the scientific investing. The this the scientific investing team. We have developed the framework and so on. Uh, yeah. So questions now, or Kamal, over to you, please.
Sure, sure. So I think this was quite interesting and quite, enriching. I myself, found it very, very, I would say, knowledge enhancing, and explained everything very simply, which is, I think, the art of very good articulation. So my foremost question, that kind of comes to my mind is, you mentioned about wealth imploders, where you were saying that there are companies which are like price to perfection, and you would want to avoid them in that third stage. If
Absolutely.
I was to kind of remind you, and I kind of ask you to extrapolate that particular thought process to overall markets today, there is this thinking. There have been few fund managers who have generated similar returns or higher returns than what you were presenting over last 1 year, and they have stopped taking money. They are of the view that now things are looking even above price to perfection, and hence they have kind of stopped it. So how would you react to that? I do see that yes, your portfolio is maintaining very low PE and is also a growth portfolio. But what is your reaction to such kind of a comment? Because when our investors, hear such kind of comment, they kind of get perplexed. They were
I
wanting to invest, they were kind of looking optimistic, but suddenly they get confused.
Sure, sure. No, excellent question, and I see this every day. I mean, I've been seeing this every day for last 3 years. Okay, so from 2021 onwards, people have been asking this question, right? And it has gone through a dip, right? 22, although at the large cap level we didn't see it, but somewhere in the mid and small cap it went down and it came up, and we saw that in the US market it actually went down by nearly 25 to 30 to 40%, depending on S&P 500 or Nasdaq. And then that both have come back now to the same level as, let's say, October 2021 or November 2021, which was the peak, right? And going above. In India, 2022 ended up with a slight positive, right? The whole year, while in between there was a dip in October or so, but at the end of it, it looked like a 7% return for Nifty or something like that, right? A low single digit number was there, mid single digit kind of number. So we didn't realize that too much, but I had people asking me this in 2021 as well, because from the 20 COVID bottom, it had been a consistent bull run that time. So from that time, this question is coming, and our answer is very simple. We don't care about how long a bull run is there. We don't care about how much percentage gain has happened, right? Those two things don't matter. What matters is what is the current valuation and what is the future growth. Both the things we have to pay very close attention to. And for the future growth, is my current valuation right or undervalued or overvalued? Okay. So first thing, like I showed you my P ratio, etc. And I'm not saying P ratio is the final answer. I mean, you have to find out whether it's below intrinsic value or not, which is difficult. You can't do it. So that's why you use P ratio, PB ratio, dividend yield, or EV to EBITDA, etc. Parameters, right? So I would encourage all the audience or listeners to look at the P ratio of any portfolio, including the market portfolio. Okay. And think about the future about the companies. What is the growth rate of these companies? Both the things you have to see. Now you will see like our portfolio is 18 or 16p, while all the other guys, if they are there, I don't know. We have been generating, 3 years everyone is talking about. You look at longer term also, and you look at calendar year by year. That is one. Secondly, you see how many stocks they have. Okay, if it's just 3, 5, 10 stocks, and that is what is driving the return. So you might show 50 stocks in the portfolio, but you have the first stock at 17% allocation, second stock at 13% allocation, third stock at 10% allocation. So just 3 to 5 stocks make up nearly 50% of your portfolio. Okay. Look at the P ratio of those portfolios. If that portfolio is at 45p, we can understand why the guy is stopping taking in more money. This is already overvalued. It's getting priced to perfection. Now coming to market level. I'll make a claim here that this is our opinion. I'm not forcing it on anyone, and you have to do your own analysis. This is not advice, and stock markets are risky. So, all the disclaimers we definitely should be very careful about. But Nifty is around 24 PE today, right? So, Nifty 24 PE looks higher. Typically, it's 20. Okay. And we would say, oh, it's 24, so it's already overvalued. But nowhere close to price to perfection or anything. Okay. When I say price to perfection, all these guys were 50, 70, 80, 120, 150 PE. That is what these companies are. While here, this is just instead of 20, it's 24, number one. Number two, Nifty is comprised of two major sectors. 35% is banks or plus financial services. 15% nearly is technology. Okay. Now, if I take these two sectors together, it's 50% of Nifty. Both of these, in our opinion, do not show the correct earnings today. Banks, all the public sector banks, not all, but most of the public sector banks, the ROE is below 10 today. Okay, except from 3, 4 larger banks. Private companies, private banks, the ROE is roughly around 16, 17. When the economy goes up, when the economic boom happens, the ROE of private banks goes to 25, 26%. ROE of public sector banks goes to nearly 18. We are at 7, 8, 9 for public sector. We are at 15, 16, 17 for private sector. So you can imagine where the normalized earnings and where the peak earnings of banks should be. If I normalize for that, 35% of the earnings go significantly up and your 24 P starts coming down. So I'm not even getting into my portfolio. I'm not getting into anything. I'm going at the most difficult, which Nifty people are saying is overvalued. Okay, so 35% of them have earnings which are nearly 60, 70% of what they should be. So there is a 50% upside to the earnings if I normalize it. Come to IT. This was a tough year for IT, as you know. Last year, there was expected recession, which never came, which we didn't expect, but everyone else was expecting in US. And so the technology outsourcing was slowed down. And so a lot of our companies who had hired crazily competitively, they had hired people at double, triple, 5 times the salaries from each other. And so everyone was sitting on higher costs. Overall, the same team was there, but distributed in different companies, musical chairs. And now everyone's cost structure were much higher. And your revenues didn't grow at the rate they're expected because the outsourcing didn't happen at that rate. Everyone in US was scared, the Fortune 500. They said, no, let's wait for 6 more months, 1 more year. If recession happens, we'll have some money and we'll not spend it. Now, despite that, so the margins of IT companies are lower this year. They are going to be higher next year. So both the E's you see, 50% of the E within Nifty PE is wrong. Actual E is higher. If I adjust for it roughly, I can say crudely, you can adjust yourself properly, but somewhere around 18 or 19 will become the PE of Nifty. Nifty itself, the most visible, most analyzed, 50 odd analysts analyzing each company in Nifty 50, that is so undervalued. So the question of that we are at the peak of bubble or anything like that, and we should not deploy more money, absolutely doesn't make sense to me. Okay. If I go to rest of the market, using scientific investing framework, and let's say your target return is not extraordinarily high. It's just that you want to be better than the Nifty. So many opportunities. Okay, you have to search, you have to do properly. This is one of the ways we showed you, and you have to create a diversified portfolio. We have a problem today that we have to reject this company because I already have 36 stocks. I'm not able to add more stocks, which I find attractive. I would love to be doing what Peter Lynch did, have 1400 stocks or 200 stocks. I'm not able to add, but I like those companies which are outside my portfolio still. Just to show you the kind of opportunity set I just did recently, deep dive, not even deep dive. I'll say I just found like diamonds lying around, and whole sectors I'm not able to include in my portfolio.
Sure. No, you rightly mentioned that private banks and IT, which comprise of 50% of your Nifty, is yet to kind of show performance. it did perform, during COVID times.
Of
But
course.
in this era, after COVID, in last 2.5 years, we have seen some of the old economy sectors, infrastructure, PSUs, defense, manufacturing, real estate. These are the
Correct.
ones that have participated. And
Absolutely.
your portfolio, when shows top stocks like Indian Railways, REC, obviously, one feels that you have been actually a very good stock picker. So when is it that
Thank
you
you.
kind of changed this in your portfolio last? In
Sure.
terms of identifying that, yes, this is going to be the next, I would say, leader in the bull run, because that will give us, some inference of how and when will you churn portfolio again in future, because trends will
Absolutely.
again change, right? So, and that will
Absolutely.
also imply what's the churn rate like.
Absolutely. Sure. So great question. So see, 2019 is when we added most of these stocks. Okay. Nobody believed that defense was even a sector at that time. Nobody believed that railway was a sector at that time. And nobody believed that power is something you should invest in at that time. Power was a very dirty word. IT was a very dirty word. That, because for many years there were power surplus and a lot of projects had gone bust, right? So they didn't fructify, right? People invested in those projects, but they didn't complete. So there was a bad thing about power. IT was the slowest growing thing. IT, which people were used to growing at 25-30% earlier, was growing at something like 5%, 7%. Because the legacy growth rate was practically 0 or 1 or 2%. And the new age business, which people didn't recognize, we saw that there is this digital transformation happening. And all the management was clearly disclosing that we have a part of the business which is just 15 to 20% of revenues, which we call digital business, but which is growing at 40%, 30 to 40% per annum. This was all known to people. We added the DX portfolio, the IT portfolio in 2018. And that time, even you would have heard of Ashwath Damodaran, who's considered Dean of Valuation. He is a professor at NYU Stern Business School. So he's considered the god of valuation. All the valuation books are basically Ashwath Damodaran. Even he gave an interview in ET Now as well as in Bloomberg in 2018 saying that the great run for Indian IT is over. Cost arbitrage was the model. You had a great run for 20, 30 years. Very good. Now you are not a 15-year-old, but you are a 50-year-old. So you are no longer adolescent. You are an old person, middle-aged person. So you should behave like that and you will grow at single digit. It's fine. And what we saw is that the top line, yes, you are growing at single digit, but your legacy is businesses, which is 75-80%. But this 15-20% is growing at 30 to 40%. And you could do a simple arithmetical or not arithmetic, mathematical calculation. And you could see 3 years later, 2021 to 2022 sometime, this digital portion would become more than 50% of the total revenues, which means that the total growth rate would go into double digits. As soon as it went into 11-12%, Mr. Market would realize, all the analysts would start writing, and this would be accelerating growth now. So what was 10% last year would be 11, 11 would be 13, 13 would be 15, and so on. Okay. And that exactly it happened somewhere post COVID in 2021. Our digital transformation growth vector started unlocking. And then, of course, 22, it went through a downturn kind of, slowdown. And now again, it is there. So this is a multi-decadal thing, but the recognition is better than 2018, but still not fully recognized, fully priced in. So these 3, 4 vectors, growth vectors, I told you we added in somewhere between 18, 19, and so on. Now, banking on Bharat or capital enablers are around 2020. Okay, they've been added around that period. And now, obviously, new growth vectors are coming in. Defense companies are getting overvalued. So we'll be moving out of those or we'll be changing the portfolio. Some other new companies will be identified. The good thing is we got those companies when they were practically single digit, 2, 3, 5 P. Today, despite 5 times, they're still close to fair value or slightly overvalued, depending on which company we are talking about. So after 5x, okay, power companies after, last 1 year, PFC, REC, what kind of stuff they've done. Of course, whenever I say name, it's not a recommendation to buy, sell, hold anything. But I mean, it's gone up so much, but it's still, PFC is hardly 7 or 8 P. It's unbelievable. So there is no reason for our power portfolio to be churned today. But yes, defense we are churning. We had pure play companies. Now we are looking for companies which have defense as part of the segments, but it might not be 100% of revenues. Okay, so the pure play opportunity is gone or is reduced, and companies which also do defense or which also do railways while doing other things but fit the scientific investing framework will come into the portfolio. So that kind of churning will happen now. And clean tech is another opportunity. But clean tech hiding in old traditional energy companies. That is the undervalued part, not the pure clean tech, which everyone knows. That will be priced to perfection.
Sure, Vikas. I think this is again, very elaborate and very interesting answer. We move on to the last question, that I think is important. If I put myself in investors' shoes, your framework looks to be very unique, very simple, and definitely scientific. And hence, kind of, it moves me also to kind of think of investing my own money. But I need to ask this question: that what is your story? What is your personal skin in the game? I have not seen any fund manager using nomenclature like doctor. You use nomenclature like doctor. So I need to understand, are we giving money to a fund manager who is like you're going to manage money for say 5, 7, 10 years, or giving money to a passionate, learned professor, who is kind of very good in, basics. But yes, there needs to be some hunger. There needs to be, some understanding of your vision and your story also before I, kind of ask my investors to seriously look at your fund.
Yeah. So as I mentioned, there was a slide which I said, how scientific investing framework evolved over 3-4 decades, and I said I'll not spend time on that. So that is the story. But skin in the game, let me tell you. So 2003 onwards, I have been investing personally, family money, etc. 2012 onwards, 10 onwards, we've been managing professional money of other people. Okay, using the same framework, and practically all of my equity allocation. So whatever money I need for my emergency purpose or for next 1 or 2 years, I need capital. That is in bank fixed deposits or something. Everything else is only in scientific investing framework strategies. Okay, on different platforms, we have more than 2 dozen strategies. We have strategies in US markets as well. Okay, so money is spread across all of those, but primarily in our multi-cap portfolio. Okay, and you can say somewhere around 70% plus at least. I don't want to be aggressive, but 70% must be in all these strategies. Anytime I launch a strategy, first my money goes in. If my money is not possible, not available, I have allocated fully. Company money is going into it, Omniscience money. And if then only we take investor money. So we are always there. Our skin, not only skin, our whole soul, we are inside the strategy. Okay. Otherwise, we don't ask any investor to come into that.
Sure, Vikas. Just one last, piece, which, I read on the chat. There is one question which someone has asked. We know that Asit Mehta is undergoing, brand renaming, and you showed that. So what is the connection between Asit Mehta, which is, you mentioned, more than 2 decade old PMS, and Omniscience? This is the last question.
Omniscience is there from Feb 1, 2017. So we just finished 7 years yesterday. Okay. And there is some shareholding between the promoters of Asit Mehta and promoters of Omniscience. So some promoters are common between those. So that's the connection.
Sure, perfectly fine. So it has been a very insightful session, and I think we have discussed seeing India as a developed economy at 50 trillion plus by 2027, and you explained that 47, and that you explained that very well. I kind of heard that yesterday in the budget speech, and then hearing that again today was very interesting, very, I would say, euphoric, and kind of reiterates our own confidence when we are selling the dream of wealth creation to our clients. When we hear such presentations and hear such fund managers, it definitely reinstates confidence. We understand equities and asset class is volatile, and we understand, yes, valuations do matter. And today, valuations are like above fair. They are now not like, very attractive. But yes, growth ahead of valuations kind of makes a case for investors to kind of be vigilant and maintain their equity allocations, and then obviously manage their portfolio through the weapon of asset allocation. And we are doing that really well. And thank you everyone for joining for this webinar. We at PMS AIF World always aim to kind of advise our clients with a lot of wisdom. And you're most welcome to join our platform and book your appointments with us. We will be doing a lot of meaningful work going ahead as well. We have been managing money for more than 500 HNIs and have grown to around 1,000 crores of assets. Our dreams are also kind of big. And thank you everyone once again for joining for this Friday webinar. I would also invite you all to see your mailboxes. We have been sending you invites to register yourself for our upcoming event, which is a 5th annual summit, which is on 23rd and 24th of February. If you have still not registered, this is a cordial invitation and a reminder for you all to register. Thank you once again. Thank you, Vikas, for your time. This was a very interesting webinar. Thank you once again.
Thank you, everyone. Thanks. Bye.